Good morning, everybody. My name is Greg Callaway. I'm a metals and mining expert from McKinsey and Company. We serve clients globally on a range of industry and functional type topics. My client base ranges all the way from Canada through to Japan, focusing on elements of the value chain, opportunities within there, as well as strategic decision making that mining clients need to make in terms of their businesses. And so today I'm going to talk to you a little bit about our perspective on where we see the commodity markets, and it's a topic that we are having more and more at the moment, particularly around portfolio strategy and how to position yourself, taking advantage of industry tailwinds and negate the headwinds that face us. And so the last 2 decades have been characterized by an unprecedented boom and bust by the industry, where over the 2000s we saw commodities rise across the board. Followed by destruction within the industry, where significant losses were made by players. We currently stand at an industry that is around $1.6 trillion. And the big question that miners, refiners, smelters, and consumers are all asking themselves, where to next. And so this morning I'm going to quickly go through our perspective and how we see the world when it comes to the fundamentals of the market, going through demand, supply, looking at some of the capital type questions we face, similarly the headwinds that will come out and disrupt the industry, and then lastly look at a little bit of M&A. And so where do we currently stand as of today? Well, 2015 we saw the bottom of the market. We have subsequently recovered, and many of the top 100 players improving their cash flows. We're now at a break-even position. Debt has been significantly reduced, and because of that value destruction, many miners looking to put dividend back into the pockets of their shareholders. And we see that approximately 40% of companies have improved their free cash flow position, as well as more than 50% having reduced debt over this period. Now, the concerning part for the industry at the moment is where's the next growth aspiration going to come from, with many of the players still lagging behind and taking a cautious wait-and-see approach to the markets. If we look going forward at how the markets are expected to evolve, I think the key message here is a differentiated view. And so what we see is a number of megatrends shaping the way the metals and mining space is going to evolve over the next decade, from a slowing down of the global economy. Many people are concerned about how China is going to evolve. Will they experience a hard landing, or will they be able to manage their economy through various stimuli over the next decade? But that slowing down is going to particularly impact your infrastructure-related markets, particularly looking at iron ore, copper, nickel, aluminium, and coal. So a broad impact there. What I would say is that for roughly around 8 of the last 9 quarters, we've seen a systematic slowdown globally, which is unprecedented in its nature. We typically see 1 or 2 areas particularly taking strife, and then others facing opportunities and growth. That hasn't been the case. But the positive is that over the last quarter, those green shoots in particularly the Southeast Asia regions have come through. If we're looking at some of the other megatrends that will shape the market, energy, as we transition to renewables, this will drive particularly downward pressure on your coals, for example. And we see that anywhere between now and the end of the decade, peak coal to have occurred. So depending on the scenario and how bullish you are on the markets, this will play a significant factor. On the converse, I think Looking at uranium is particularly attractive if you're looking at the Chinese market. They're looking to build around 12 reactors over the next handful of years. This is particularly insightful, particularly interesting from the fact that most of the Western world looking to reduce their capacity. So overall net growth in the uranium market and so energy market over the next decade, particularly driven by China itself. Then I think the one that really we see that is most common and most talked about at the moment is around e-mobility and the consumer market. Everybody's talking about the rate of adoption that vehicles will play, and we see that over the next decade there'll probably be around 16 million vehicles, EV vehicles, being built. It's largely stimulated through Asia, where we see a lot of development. Today there are roughly around 64 companies that are looking to play in the EV space. That is going to increase to more than 74 over the next couple of years. And so I think this shows the importance that Chinese players are putting into the market and the tailwinds that they see. And then lastly, I think if we talk about the financial markets, the instability that we see at the moment, we think that this will continue and will put upward pressure on gold, like we see in the last couple of months, and this will drive the next wave of gold activity. What we see broadly across these commodities as demand evolves going forward is that the nature of demand is going to change, and it's getting quicker and quicker. The chart that we show you here is that the time it takes for commodities to grow to a $5 billion cap as a result of certain trends. If we look at yesteryear, some of the big trends like steam engines, crucibles, electromagnetic induction, these all took a century to develop and get to scale. But if we look at what's happening now and today, we see that lithium, cobalt, cathode materials used in batteries will probably take around 40 years and are hitting that $5 billion cap at the moment. And I think this is going to be systematic of a range of tailwinds, trends that we see in the market, and the markets are going to change ever quicker going forward. Where do we see the pockets of growth if we're looking at demand over the next decade? Well, electric vehicles, like I said, is a key component, and this is going to have a broad impact across a range of commodities. Particularly if we're looking at elements like copper and aluminium, which are significantly used within the EV space, particularly around batteries. Copper, for example, in your light vehicles is 4 times more intensive in your EVs than your internal combustion engines. Yes, we may see thrifting of the material over time, and we've seen it already in the cabling, as well as on the battery side of things. But to a large extent, more intensive use of copper will be used. Similarly, aluminium used in the bodies of the vehicles. This will play a large role in its growth. Both of them growing roughly $15 billion and above over this period, year on year, on an annual basis. Some of the more interesting ones, as we see come through, will particularly be around your EV battery materials, so your nickel, cobalt, and lithium. But we'll also see things like cobalt, graphene, vanadium, titanium, and tellurium come through and play a role. So rare earths, more niche applications, being used to take advantage of the growth in various trends. We've talked a lot about electric vehicles, but this similarly applies to grid storage, aerospace, wind and energy, and then similarly like electric planes, all hot commodities coming through over the next decade. The big question if we change shift and look at the mining side, is how are we going to keep pace with this growth that we see in the market. And our MineSpans team, which is our in-house think tank around mine supply and costs, they're able to tell us that the current capacity and announced pipeline of projects will only be filled and meet the closures in the market. And so there's an additional gap of induced incentivized supply, which needs to come on the market for demand or supply to meet demand. And so what we see based on the current announced pipeline is that your Latin America, particularly with your copper assets, they are the major projects which will come online. These include Cobre Panama, Chuquicamata. We look at Oyu Tolgoi, Quellaveco, as well as the potash Jansen Phase 1, all being major $3 $5 billion plus investments which will fill the gap. But like I said, there is a significant deficit in the announced capital spend that is required in order for supply to meet demand. And so talking about capital, we think that capital is going to grow significantly over the next decade, roughly around 82% increase from today. This is around both the exploration and stay in business side, which needs to increase, but similarly on the actual investment in growth capital. And only about half of the growth capital that is expected in 2028 is actually being announced, and players will need to fill that gap. Now, some of that may be filled internally, and companies know of those growth strategies and aspirations, but there is a large element that still needs to meet the market. And so the growth capex side, if we look at it, roughly around $130 billion in spend. This is only increasing one, because of the geographical location that projects will be found over the next decade. The announced projects in safer, more known regions, but there's going to be a shift towards unknown elephant country regions in order to fill the pipeline. This is going to require infrastructure and similarly additional spend in getting these remote places up to speed. I think what we also need to consider in terms of spend in these spaces is how the mine of the future is going to evolve, and looking at like the Internet of Things, digitization, advanced analytics. These are additional spend items which mines will need to build into their budgets as they think about setting themselves up for success. And we're seeing more and more of this space happening with companies trying to plan better in terms of what the next wave of mining is going to look like. And so the big case in point that happened many years ago, and they really took the lead, is Dundee Resources, and how their Chelopech mine was transformed to take advantage of digital and analytics. And so while that was really the forefront of taking advantage of these tailwinds, but really now, if you're not thinking about it, you're really lagging behind. And this is going to have a significant impact, and we see a bifurcation in the market of those who are able to take advantage of digital and analytic topics and those who can't. Talking about capex as the big point, but I think there are a couple of other elements that I'll touch on next, which miners will need to think about over the next decade. One of them is around productivity. The other one is on exploration. If we're looking at productivity today is still significantly below that of 2004. And what we see is that despite marginal improvements over the last few years, that there is still a significant amount of work to be done. We think that many of the throughput opportunities, the cost reductions that players have implemented over the last couple of years because of the cash constraints that they're experiencing, those have been implemented. They have already seen the benefits, and in order for the industry to get back to levels that it's previously seen, it's going to need to take advantage of those digital and analytic opportunities that I spoke to previously about. But this is also a good thing. We talked initially and we set the scene around free cash flow. We talked about the growth in dividend and reduction in debt. This has leaned companies, made them stronger to take advantage of the growth that we see going forward. And so we see this as a strong platform for the industry in adopting new technologies and being able to do that going forward. I said that the next wave of opportunity really is going to come through digital and analytics opportunities, and we see that these opportunities lie across the mining value chain, but particularly if we're looking at concentration and maintenance, this is where the biggest changes are seen. One is that the opportunities here generally are less capital intensive and can be easily implemented, and so are being taken advantage of by various companies. But similarly, a lot of them filter through and have direct impact on your bottom line. And so if we're looking at like the concentrator plant, we're looking at smelting and refining type opportunities. What we've seen is 1 to 3% improvements in this space has a big impact on bottom line cash flows for businesses. Big case in point is recently the work that we did with Freeport in the improvement of their concentrator plants using advanced analytics, and they're said that across their business they're likely to be able to, over the next coming years, increase copper production by 90,000 tons just by these improvements. The second key issue that the industry is facing at the moment is around reserves, and particularly for certain segments within, and we're looking at gold for example, this has become a reserve crisis. This is going to inhibit players from growth and taking advantage of the demand increments that we see going forward. We estimate that over the next decade that roughly around 38% of current reserves will be exploited and need to be replaced, with only half of that, or even less than half of that, being able to be replaced by what we are spending today in terms of exploration, and being able to convert your exploration into reserves and economical mining activity. And so this is a significant issue for most commodities within the space. I think the one commodity which isn't as affected would probably be copper, where we see that over the last decade, major players have been able to improve their reserves twice as much as what they've been able to extract. But for many of the other spaces, have not been able to discover and exploit new reserves, particularly tier 1 reserves, in order to fill this pipeline. And so we see that taking advantage of technology over the coming decade will play an important role for companies to, one, identify resources, but also be able to convert them quickly and effectively. We've seen the work that has been done by Goldcorp at its Red Lake operations by using external providers to look at their data sets and improve their geological insights, and they've had success in that space. We also see players like Ryan Shaw in the Canadian space taking advantage of new technologies, looking at the whole exploration value chain, from drones to quick and simple identification methods of sampling, in order to extrapolate your current resources and identify or try and identify where the next major resource will come from. Similarly, if we look at gold spots and the work that they've done, Vale last month announced that they will be using them to help them better understand their geology and grow their resources and reserves. Taking in consideration where supply and demand is, what we see is that there are a number of tailwinds and headwinds that commodities will face. And what you see here is our way of depicting the attractiveness of commodities. This is particularly your price versus your marginal producer. And so, if we're looking at this, cash cost is can be identified by mining companies looking at their immediate operations and what they can do at their assets. Brownfield being able to expand those activities and look at opportunities in the immediate area of their current operations. Greenfield taking it one step further and looking at new opportunities that are unknown to them. And then lastly, fly up, where prices are high enough that any action you do will drive further profits for the business. And so what we see is that for your steel making and energy materials, there's typically headwinds because of the renewables and slowdown in infrastructure activities that we see. On the opposite side of things, if we're looking at copper, aluminium, your EV battery materials, because of their association and linkage to your EV materials, the growth in EVs of this period, we'll see them taking advantage and upward pressure on prices being placed in this space. And then lastly, if we're looking at fertilizers and precious metals, we're bullish largely on these as well for various reasons. Bringing this together, we see that there are a number of opportunities across the various commodities that have different rates of attractiveness. But I think the takeaway here is that to a large extent we are bullish across all commodities, and that there are opportunities that lie within. What I would say is that despite the headwinds that are being faced by your steel and your energy materials, we see that there are subsectors within that, because of the depletion that is experienced within these commodities, they will still need to be replaced and filled by new projects, and that in itself lies further opportunity for miners, particularly those who have a strategic advantage against other peers, i.e. Higher calorific values, etc. And so the value pools that each of these commodities bring out over the next decade will force different plays to take place for miners to take advantage of these tails and headwinds. If we're looking at the bottom left-hand side, the quality play, this is particularly looking at your steel-making raw materials plus your energy materials. This is around differentiation and being able to show an improvement against your peer, whether it be structure on the cost curve or being able to have a higher calorific value. Particularly going into the Chinese market, which because of the environmental pressures that they are currently experiencing, being able to give them a quality of material. The second is around brownfield play. This is mostly around your aluminium and your lithium space. Lithium, large amounts of resources. We think that they'll be able to be brought online despite the strong growth within the industry. And really it is around managing the timing of those that'll be important for those two. Then we go to consolidation, and I think most of this is happened already. If we're looking at potash, phosphate, and chrome, oligopolistic in nature for your fertilizers, and then chrome similarly, given the downward pressure that they've received recently, many players, particularly in South Africa here, having consolidated under one umbrella. And then top right, your exploration play, where your major commodities like copper and gold, and we are highly opportunistic, or we believe that copper and gold, as a combination, is highly attractive for investors, particularly because of the credits that they give against each other, but also because of the structure of the industry, that you see steep cost curves, prices that are supported by strong tailwinds in the industry, and will be sought after by investors going forward. But then similarly, if we look at your nickel class 1, the material that's used in EVs, this will be sought after, particularly given the deficit that we expect to ensue, and the lack of attention and expansion that your large players have put in this space. The converse is, if HPAL is or HPAL comes to fruition, the technology is becomes credible, and that the success rate moves from the 1-to-1 that is currently experiencing to something that is more consistent, particularly with the feed throughput issues that they experience, but also reducing the capital intensity. We could see that the class 2 bubble moves further to the right and becomes more attractive. But to a large extent, we are bullish on this. So to take advantage of these tailwinds and headwinds that the industry is facing, a number of plays are going to need to take place. We think it's more than just putting your eggs in a basket which you see commodity prices rising. There are also actions that players can take to reshape their portfolios, to move themselves further left on the cost curve, that will drive value creation within the industry. M&A and divestitures is one of them, and what we see at the moment is that the spend that's being put in this space is significantly below 2011 highs, as well as historic levels, and most of it being put into the gold space. And we think with gold prices being high at the moment, it's likely that consolidation within the space beyond what we saw with Barrick and Randgold, as well as your Newmont Gold Corp move, will take place. Here's the sanitized example of how we see one of the major diversifiers shaping up over the next decade. We see that in order to take advantage of tailwinds, portfolios need to be shifted and adjusted consistently, and we see that for the majors, it's meant that there's been a simplification in the portfolio, as well as adding additional cash flows in strategic areas over time. And these shifts in portfolios will help better improve your positions over the next decade. And what we see is that our team from Mindspans, which I said was the solution space on the supply and cost side, they've taken the cost curves that we normally see across commodity and normalize them into one curve to be able to compare peers against one another from different commodities. And what we see is that over the next decade, we're going to see leaders and laggers emerge over the space. Those players that have looked at their strategy and redefined it versus those who have stayed stagnant. And of the 10 major players that we see in the industry, 5 of them are expected to improve their position, i.e. improve their performance against peers, and 5 of them are expected to reduce their performance against peers and move from left to right on the curve. And when we've had this conversation with clients of ours, and we've been able to show them where they are today versus the evolution going forward, in some cases we've had staggering remarks back. One's being that you don't know what you're doing, you do not understand how the market is, to 2-3 days later coming back, we've spoken to our analysts and we think you could be right, and we need to make drastic changes going forward. And so being able to benchmark yourself and understand what your peers are doing and what you're going to be doing going forward becomes incredibly powerful in defining your strategy. Similarly, over the next decade, there's going to be a number of disruptions that could play out within the industry. The one that particularly is of interest and a hot topic at the moment is around decarbonisation, and we think that over the next decade, this is going to be the one, if not up there, the most important conversation that CEOs are going to have, particularly between them and their management teams as well as their shareholders. We see at the current trajectory that CO2 emissions will probably rise 2% year on year going forward, and that in order to combat and get to the 2-degree decarbonisation scenario that is being talked within the industry, a drastic shift is going to need to take place in order to reduce carbon emissions between 40 and 70% over the next decade. And we see that metals and mining in total probably contributes about 14 gigatons of CO2 emissions, and about a third of that into the mining space. That is a significant amount of emissions that is going to need to be reduced and planned for. And those companies with their portfolios that have a significant exposure to the coal space will need to think about how they reposition that, and many of the players have, whereas those who have, for example, copper or aluminium will take advantage of the tailwinds that are associated with your decarbonisation, particularly as you look to use more copper, for example, in these applications. So the takeaway towards mining companies over the next decade and the CEO agenda is likely to evolve around three things. One, growth, taking advantage of what's coming ahead, and selectively going after acquisitions, as well as developing exploration opportunities that lie. Two is around technology, being able to position yourself at the leading edge, and those that do not will likely lag behind and be unable to meet and match their peers. And then lastly is around sustainability and the decarbonisation topic, as well as looking at your operating to license, communities, etc., that are going to ensue and become more and more part of the CEO agenda. Thank you.